Welcome back to Stock Spotlight. I'm your host, Michael. Today's episode is a quarterly portfolio update where I will walk through 3 companies that I own and assess how the investment thesis is tracking over time. For each company, I'll cover the original thesis, 2 key KPI checks, the current market debate, my view on the outlook, and wrap it up with a simple green, yellow, or red rating. The goal with these updates is to stay grounded in the data. Each quarter, I'll rotate through different holdings and focus on both storytelling and execution, and whether the original underwriting still holds up. Today, I'm covering Fortinet, Ferrari, and Union Pacific. Let's dive right in. First up, Fortinet. The thesis remains centered on durable demand for integrated cybersecurity platforms, margin expansion through mix shift towards software and services, and sustained enterprise network security spending. Longer term, the underwriting depends on Fortinet continuing to gain share through platform consolidation, which supports both stickiness and operating leverage. My first KPI that I like to check with them is billings growth. Billings reflects total customer invoicing in a period, including both recognized revenue and deferred revenue, and is often viewed as a clean measure of demand. In fiscal year 25, Fortinet generated around $7.55 billion in billings, up roughly 15.6% year over year, with Q4 billings of about $2.37 billion, up roughly 18.3% year over year. Sequentially, billings accelerated through the back half of the year after softer growth earlier in fiscal 24, suggesting demand improved exiting the year. Looking longer term, fiscal year 25 growth sits below pandemic-era peaks, but remains consistent with Fortinet's normalized mid-teens expansion profile since 2019. The second KPI that I like to look at is service revenue growth. Service revenue reflects recurring subscription, support, and maintenance fees. In fiscal year 25, service revenue totaled about $4.58 billion, up roughly 13.2% year over year versus $4.05 billion in fiscal year 24. Services represented roughly 67% of total revenue in fiscal year 25, reinforcing that shift toward recurring revenue. From a trend standpoint, service revenue growth has decelerated from the low 20s range seen in 2022 and 2023, but remains solidly double-digit and stable on a multi-year basis. One other metric to watch with Fortinet is remaining performance obligations, or RPO. RPO represents contracted revenue not yet recognized, including both deferred revenue and future performance under signed multi-year agreements. Total RPO reached about $7.18 billion in fiscal year 25, up roughly 11.9% year over year, while current RPO rose about 10.8% year over year to $3.66 billion. Growth has slowed versus the 2021 to 2022 period, but remains steady and supportive of forward visibility. The market debate currently centers on whether billings normalization signals structural deceleration or simply digestion following outsized pandemic demand. Bears point to firewall cycles and SMB exposure, while bulls highlight platform consolidation, enterprise refresh cycles, and strong services momentum. In terms of Fortinet's outlook, near-term growth may remain uneven as spending cycles normalize, but improving mix, strong backlog visibility, and operating leverage support continued margin expansion. The key watch is whether billings re-accelerate alongside enterprise refresh cycles over the next 12 to 18 months. With all this in mind, I give Fortinet a green rating. Their execution continues tracking closely with my underwriting, backlog remains healthy, and mix-driven margin expansion supports long-term confidence. Next up, Ferrari. The thesis remains centered on controlled scarcity, sustained pricing power, and long-duration demand supported by Ferrari's disciplined production strategy. Longer term, underwriting depends on Ferrari maintaining brand equity while evolving toward electrification without diluting desirability or secondary market strength. My first KPI check with Ferrari is its ASP resilience. In fiscal year 25, Ferrari's global ASP per unit shipped was about $440,249, calculated as cars plus spare parts revenue divided by total shipments. That represents roughly 6% year-over-year growth, falling 11% in fiscal 24 and 15% in fiscal 23, showing that pricing has slipped but still remains relatively strong. Over a longer period, ASP has risen consistently from about $289,000 in 2019 to $440,000 in 2025, reflecting sustained mix improvement, personalization revenue, and disciplined supply. The second KPI that I like to look at is their electrified mix, which includes both hybrid and fully electric vehicles. This mix increased from roughly 22% in fiscal 22 to about 42% in fiscal 25, a nearly 20 percentage point increase over 3 years. The shift has progressed steadily year to year and aligns with Ferrari's longer-term target of roughly 60% electrified by 2030. The key risk is whether higher electrification ultimately pressures ASPs, resale values, or brand perception over time, since part of Ferrari's pricing power historically reflects internal combustion scarcity and emotional appeal. Sustained ASP strength alongside rising electrified mix will be the clearest signal that the transition is working. Another metric to watch out for Ferrari is their order visibility. Ferrari's order book remains strong, with visibility extending through at least 2027 and production largely sold out through 2026, according to recent company commentary. This level of forward coverage supports near-term revenue visibility and reduces earnings volatility relative to most auto manufacturers, where demand tends to be far more cyclical. The market debate increasingly centers on the electrification risk, including resale values, long-term collectability, and whether newer tech-heavy models maintain Ferrari's traditional emotional appeal. Investors are also watching whether ASP growth can persist as electrification accelerates. In terms of their outlook, Ferrari's near-term fundamentals remain strong given the backlog visibility and continued pricing power. However, longer term, the key swing factor is whether electrification expands Ferrari's addressable market without weakening its scarcity-driven positioning. I give them a yellow rating. Execution remains strong today, but the October 25 guide reset, accelerating mix shift toward electrification, and growing questions around resale values and brand durability increase long-term uncertainty. Last but not least, Union Pacific. The thesis here hinges on operational execution and long-term volume recovery, supported by durable pricing power and incremental productivity gains. Longer term, underwriting assumes rail continues benefiting from modal shift, which is freight moving from trucks to rail due to fuel efficiency and network density advantages. The story ultimately depends on both cyclical volume recovery and sustained structural efficiency gains. The first KPI that I like to check with Union Pacific is total revenue carloads. This measures the number of freight cars moved that generate revenue, which is essentially a proxy for shipment volume across the network. In fiscal year 25, total revenue carloads were about 8.45 million, up roughly 1.36% year over year. In Q4, total revenue carloads were about 2.07 million, which was down roughly 4.16% year over year, reflecting mixed demand across intermodal, industrial, and bulk categories. My second KPI for Union Pacific is their operating ratio. Operating ratio is calculated as operating expenses divided by revenue. So lower is better because it means the railroad is keeping more profit per dollar of sales. Fiscal year 25 operating ratio came in around 59.8%, which was an improvement of about 10 basis points year over year, and reversing much of the prior year deterioration while still reflecting major efficiency gains versus pre-precision scheduled railroading levels, which was before the industry shift to leaner, more scheduled operations. Another metric to watch with Union Pacific is pricing, as this remains the key swing factor. In fiscal year 25, core pricing ran about 4%, while volumes were roughly flat, which means most revenue growth still came from price rather than volume. The market debate remains focused on whether volume recovery can accelerate and how much incremental margin expansion remains after years of productivity gains. More recently, the proposed UNP-NSC merger has become central to the debate, with bulls pointing to potential network efficiencies and service improvements, while skeptics highlight regulatory hurdles and integration risk. In terms of their outlook, near-term results for Union Pacific will depend heavily on macro-sensitive freight categories like intermodal and industrial shipments, with recent trends showing mixed momentum across segments, including softer premium volumes and stronger bulk-related categories late in the year. Longer term, the merger discussion introduces upside optionality, but the core story remains pricing discipline, productivity improvements, and gradual volume recovery. I give them a yellow rating. Execution is solid overall, but softer volumes, continued macro sensitivity across key freight categories, and uncertainty around the proposed merger limit near-term conviction despite steady pricing and efficiency gains. And that's it. That's my first quarterly portfolio check-in across Fortinet, Ferrari, and Union Pacific. The goal here is simple. Make sure the facts still support the original underwriting. Regularly reviewing your holdings builds discipline, sharpens conviction, and helps separate real signal from short-term noise. I'll keep doing these across different positions, and I'd love to hear what you're watching most closely in your own portfolio. If you enjoyed this episode, drop a comment or vote in the episode poll. And for real-time updates, follow me on X at Invest091. Join me next time when I break down the insurance brokerage industry. Until then, keep your investments smart.